Hello, welcome to Handout 17. In Handout 17, we're going to be returning to financial accounting. I bet you thought you were done with financial accounting, but you're never done with financial accounting in finance. As Warren Buffett says, financial accounting is the language of finance. So we're going to be returning a bit to financial accounting and learn how to project forward financial statements into the future. This is going to be useful for us in two ways. First of all, if we're doing ratio analysis, it's very helpful to have estimates of financial statements in forward periods to look at and create ratio analysis from those. So that'll help us to understand and predict the performance of companies we might be interested in buying the stock of or making a loan to. And the second reason that this is going to be helpful in general is when we are trying to value an entity using DCF methods, getting the NPV for the project should we buy this company, hold it for a while, and sell it. Projecting forward financial statements is in general required to determine what free cash flows we think we can obtain from the entity while we're owning it. So that's why I'm torturing you with this stuff. Hopefully it won't be torturesome for most of you. And on that note, let's jump right in. Okay, so pro forma financial projections. What are pro forma projections? All they are projections of our financial statements into future accounting periods. And why do we care? Why do we want to do this? You should always be questioning, why is he torturing us with this stuff? Well, there are a couple needs for financial projections, pro forma projections. The first is, remember we spent a lot of time on ratio analysis of financial statements. That was really helpful, except it was all based on history, right? So that limited our ability to predict what was going to happen in the future with an entity. And we can help overcome this problem by creating pro forma projections of financial statements into the future with some simple assumptions, and then perform ratio analysis on these future periods. And that's going to turn out to be very helpful for trying to estimate how an entity is going to perform in the future. Our second need goes to our DCF entity valuation methods, and especially NPV is what we've been working with mostly. And remember, the NPV of a project is equal to the sum of the present value of each cash flow, present value at first, then add them all up, and that's the NPV. So the problem, these are all cash flows in the future, except for maybe one that happens at t equals 0. So the issue has always been how to estimate those beautiful future cash flows. And we saw that with bonds or loans, it's relatively straightforward, right? We can use the contract, what the contract says the cash flows have to be, and provide some risk adjustment. And we looked at different models for providing risk adjustment, particularly the opportunity investment model. And if we're valuing a company or a company's project, it's much more difficult. And if we create pro forma projections of our financial statements, we can project what our free cash flows are going to be in the future. And remember, we looked at this future business when we first looked at valuing entities. So we said that the free cash flow for an entity, this would be to shareholders in the year I, would be the net income in that year plus depreciation minus changes in working capital minus capital expenditures plus any changes in debt. And we looked at a very simple example where everything dropped out because we had a steady state entity except for net income. But usually, of course, companies are going to be growing, things are going to be changing. And to get all these quantities, we have to project forward our financial statements. Changes in working capital are going to come from projecting balance sheets. Changes in net income are going to come from projecting our income statements, and CapEx comes from our cash flow statement, et cetera, et cetera. And similarly, if we are valuing an entity to all stakeholders, we have something very similar going on. We have NOPAT, which is our net operating profit after tax, which is EBIT minus tax on EBIT, plus again, depreciation, changes in working capital, et cetera, et cetera. So to get all these numbers in the future, we're going to have to use pro forma in general, have to use pro forma financial statements and pull these quantities that we want out of those projected future financial statements. So with that in our pocket, what's our framework for creating ProForma? So as usual, let's say we're at t equals 0, right? And that'll correspond to end of period 0. And at this time, under all circumstances, assets equals liabilities plus equity. We'll say that that's true for now. And then what we want to do is we want to project the financial statements forward by one period to t equal 1. That could be end of year 1 in the future, end of month 1 if we're doing monthly projections. So what are we going to do? We're going to use, and here I sound like an economist, but we're going to use quote unquote reasonable methods to estimate the value of all of our asset, liability, and equity accounts in the future, and we'll do it in such a way that at the end of period 1, assets at the end of that future period 1 are equal to liabilities plus equity at the end of that period. So I know I'm being crazy and squishy with this reasonable method, so let's think about that a little more. So what do I mean by reasonable methods? We're going to use reasonable methods to estimate account values. In general, for us, this is not true for super sophisticates working at Blackstone or private equity firms doing special deals, but for general case basic stuff, good place to start is we will assume the future looks kind of sort of like the past. And what I mean here now is that we're not going to have any disruptions in the industry. Uber is not going to come in and upend the taxi industry, for example. We're not going to have a major recession or depression, and the CEO of the company is not going to go crazy and say, all of a sudden, we're changing the whole company from making cars to making only toothbrushes or something crazy like that. So that's number one. Also, more reasonable methods we're going to use are to say that to compute any account's future value, wherever possible, we're going to use an accounting formula. Okay, so that's a formula from accounting, okay, an accounting formula, or a CEO's directive. So here's an example of a formula. The interest in period 1, as it has been all semester, as hopefully you learned in accounting too, is going to be the debt at the beginning of the period times the interest rate. And a CEO's directive could be something like this. The CEO or the board of directors or the CFO could say, we are going to hold our debt level constant for the next 2 years. So that would just say debt in year 1 is equal to debt in year 0, etc. And then finally, for any account where we don't have a formula or a directive, we're going to assume this, that the value of account X divided by sales in period 1 are equal to, proportional to, the value of account X over sales in period 0. And this assumption is what's called a constant percent of sales assumption. And actually, as you're about to see, it's actually a really good assumption for balance sheet accounts as well as income statement accounts. So here's how we'd use it, for example. So accounts receivable has been running at about 10% of sales. So we're just going to assume that going forward, whatever the sales are, that accounts receivable is going to continue to be about 10% of that. Okay, so these are our reasonable methods. So no big disruptions. Future sort of looks like the past. Wherever we have a formula, an accounting formula, or a company directive, we'll use that to project forward. And wherever we don't, we're going to use this constant percent of sales assumption. So with that in our pocket, here's our little algorithm, or algorithm, as you know, is just a fancy word for recipe. So here's our little recipe for projecting forward. So we're going to need some historical balance sheets, income statements, and we're going to need depreciation, capex, and equity roll forward equations. I'll remind you of those. Those are something I'm sure you learned in financial accounting and might need a little reminder. And then next we'll make reasonable assumptions about the future. So something like the future will look like the past, except that we think we can grow sales by 10% instead of 8% or something like that. We're going to, in future period 1 here, we'll solve for account values using the historical financial statements, right? Because in general, the future will look like the past, and our reasonable methods. And then there might be some final values that we haven't gotten from a directive or to say they're going to be proportional to sales. So to get any final leftover values, we use one of these two accounting equations to help us out, that assets equal liabilities plus equity at all times under all circumstances, and or equity beginning of period plus net income plus paid in capital minus dividends is equal to equity end of period. So we'll do that for our first future period, and then if we want to go into further future periods, we just do the same thing for period 2, and et cetera, et cetera, et cetera. So it's relatively straightforward. We're just going to have to keep our wits about us as we go ahead with this. So usually when we project, we're projecting at least in part to answer what I like to call a big question about one account. So let me show you some examples of what I mean by that. So the CFO could ask us, if we follow the company's planned strategy, how much cash will we have 2 years from now? That's a big question. Okay, so that would be the key for creating all the projections in this case. Another example of a big question is the board could say to the CFO, given our current strategy, what's the biggest dividend we can issue for the next 2 years? So the big question would be, what's the size of the dividend the company can issue for the next 2 years? In all these cases, we're going to project all the other accounts. So we would project everything but cash here, we'd project everything but dividends here, and then we're going to use one of these two accounting equalities to help us solve for that one missing piece, that one big question piece, account value. All right, heads up that as we have already learned, seasonal companies we have to be careful about. When we did ratio analysis for seasonal companies, we had to do quarterly or even monthly comparisons year on year, and that's going to be true when we project forward as well. So if we have a seasonal company, we're going to have to project month by month or quarter by quarter, and non-seasonal companies we can project ahead year by year.